Well, for more on this, we will speak now with Derek Scissors. He's a senior fellow at the American Enterprise Institute and also the chief economist of the China Beige Book. Derek, thank you very much for joining us. Firstly, I just want to get your take on the timing of this decision and the overall strategy here. I mean, the tariffs sound pretty specific.
Now, the timing is obviously political. It doesn't take 3 years to review tariffs imposed by a previous administration that you don't like. If you wanted to change them earlier, the Biden administration certainly could have. Now we're 6 months away from a U.S. election, and suddenly we're able to move. The tariffs were pretty specific. The main target here, there were some other potentially important targets. But the main target here is electric vehicles, electric vehicle components, and semiconductors, because the U.S. is concerned about a potential surge in Chinese shipments of those products. They've all been labeled as important by Chinese industrial policy. They all receive a lot of benefits from Chinese industrial policy, financial and otherwise. So the Biden administration is looking down the road and thinking in 2025, 2026, we could see a flood of Chinese goods in these areas, and we want to get out ahead of that. But they could have done that last year. They could have done it next year. They're doing it now for the election.
Yeah, well, Derek, Biden's measures seem more targeted than Trump's blanket initiative. Trump had lower tariffs but covered more than $350 billion worth of imports. This time, Biden's only covers $18 billion, but with higher taxes. So how different is Biden's approach from his predecessor?
Well, let's remember that Biden also kept all the other Trump tariffs. He had the opportunity to change them all. He could have made, reduce the scope, so it's not 300 billion, it's 100 billion. He could have raised the levels. So this is just a tack on to what the Trump administration did, looking down the road to some important industries. I don't think it's very important. Very different. I also don't think it's very important. And because both the Trump and the Biden tariffs share this failing of, if China ships the goods through another country, it escapes the tariffs. That's already happened with shipments of small goods to the U.S. that are worth less than $800. It could easily happen with EV components in Mexico or EVs in Germany. So it looks like it's not different from the Trump approach at all. They accepted most of the Trump approach. They added this on. It has many of the same strengths and weaknesses.
And Derek, what's the anticipation in terms of how Beijing may retaliate? Should we be bracing for potential tit-for-tat scenario that we've seen before where tariffs on each other's goods could escalate?
Yes, I think that'll happen. I don't think it'll get out of control. I think China will look at the scope of the tariffs and say $18 billion, we'll put tariffs on $15 billion to show that we're more reasonable than the United States. And they won't go beyond that, and the U.S. won't retaliate against the Chinese tariffs. So we're going to get Chinese retaliation. I don't think it's very significant. Really, the only way the U.S. move matters is if the U.S. is going to block Chinese products when they come from other countries. So when that 100% tariff applies to Chinese products that come through Vietnam or whatever, then the U.S. move would matter. And then we would see more serious Chinese retaliation. But for right now, I think the Chinese will just look at the $18 billion and say, we're going to do the same thing you did. And that will be the end of the tariff exchange. It will not, escalate the way the Trump administration tariffs did.
But Derek, this situation might not be limited to the U.S. and China because the U.S. is not alone in criticizing China's trade practices. The EU is in the midst of its own anti-subsidy probe on Chinese EVs. So do you expect similar tariffs from other countries, perhaps, and perhaps a widening trade war?
Yeah, that's a good point. The EU, I think, has been thinking about low tariffs. And when the U.S., raising tariffs on Chinese EVs and EV components, but when the U.S. goes to 100%, the EU can't go to 20%. That's a waste of time. Don't do anything if you're going to go to 20% when another major trading power has gone to 100. So you could see the EU impose pretty high tariffs, which is going to make China unhappy, let's say 50% tariffs. But we've also seen the EU say, oh, well, if there's more Chinese investment in the EU, that would be fine. France just said that recently. Oh, you could make the electric vehicles here. So what EU tariffs might be an invitation for China to invest more and produce goods in the EU. And if that's the case, it will appear that the trade war is widening. But in fact, the EU and China already have a way to de-escalate which just involves China investing more in the European Union.
Yeah, well, Derek, you mentioned earlier about the potential sidestepping of import tariffs in the U.S. We did hear from U.S. Trade Representative Catherine Tai recently, and she did raise concerns about, Chinese EVs made in Mexico. Do you think these types of import tariffs that will block imports from third-party countries, do you think that's a likely step for the U.S.? Is that in their calculation at the moment?
That's the big question. And the answer is it should be. I mean, why are you putting 100% tariffs on products when they can easily be circumvented? That appears to be a complete waste of time. On the other hand, the Biden administration should have announced all these things together. They should have said, and this is our attitude towards EVs or components or semiconductors or solar cells or whatever it is that are made in third countries. This is what we're going to require. Most of the content has to be Mexican or German or Vietnamese or whatever it happens to be. We should have policies out on that. So it is a natural step for the United States and something to watch for, something China will watch for. But there is the question of why didn't you do it today? And the Biden administration has been very slow. It had an EO on outbound investment, executive order on outbound investment, August of last year, still not implemented. So maybe the U.S. is considering those rules about what to do about Chinese goods produced or shipped through other countries, but we don't see them until 2025, in which case they don't really matter unless the Biden administration wins and actually goes forward with implementation.
And Derek, some experts also point to worries that the levies might hinder America's industrial ambitions, by inadvertently sort of insulating them from their fiercest foreign competitors, thus potentially stifling market competition within the U.S. Do you share their concerns? And how do you ensure there still is sufficient competition within the U.S. market?
Well, the weird part about that is there really isn't that much U.S. demand for EVs. And so it's not like you're looking at a booming industry where you'd really be concerned about, okay, we really want to have competitive products and good products for consumers. This just isn't a big enough industry. I guess given that the American industry is not booming, I think the primary concern here is that China has a lot of overcapacity in autos in general and EVs in particular in China. We have Chinese companies that are selling way below cost. And we know this, and they've been doing it for months. And so the primary concern is Chinese dumping, whatever you want to call it, a flood, a China shock too, but dumping of below market cost vehicles. I think if the U.S. market were booming, you would say, well, there's room for everybody for right now. Let's have the competition. But since it's not booming, I think China's track record in building up excess supply and sending that overseas is the primary concern. And U.S. reasoning that these products need to be blocked is sensible.
I appreciate your insights today, Derek. Derek Scissors there, Senior Fellow at the American Enterprise Institute.